Question 6. How does the BOXX ETF manage volatility compared to similar ETFs? The BOXX ETF targets lower volatility compared to several similar ETFs by combining its underlying holdings and the BOXX spread strategy. Here's a breakdown of how it aims to achieve this. BOXX ETF's approach to lower volatility. 1. Underlying holdings. Short-term Treasuries. The core holdings of the BOXX ETF are ultra-short-term Treasury bills with maturities ranging from 1 to 3 months. These government securities are known for their low volatility as their prices are less sensitive to interest rate fluctuations compared to longer-term bonds. 2. BOXX spread strategy. Defined range. The BOXX spread strategy employed by BOXX ETF creates a defined range for potential returns. As long as the price of the underlying security, often a Treasury note or bond with a slightly longer maturity, stays within this range by the expiry date, the ETF's returns are less impacted by market movements. Limited upside, capped downside. The purchased call option limits the potential upside of the BOXX ETF if markets surge significantly. However, the sold put option offers some downside protection if markets fall. This dampens the overall volatility of the ETF's returns. Comparison with similar ETFs. Money market ETFs. These ETFs typically invest in a variety of short-term debt instruments, including certificates of deposit, CDs, and commercial paper, alongside Treasuries. While offering some stability, they might have slightly higher volatility than BOXX due to the inclusion of corporate debt, which can be more sensitive to credit risk and interest rates. Short-term bond ETFs. These ETFs invest in a basket of short-term bonds with maturities ranging from 1 to 3 years. While offering potentially higher returns than BOXX, they expose investors to greater interest rate risk. As bond maturities lengthen, their prices become more sensitive to interest rate fluctuations, leading to higher potential volatility. High-yield bond ETFs. These ETFs invest in corporate bonds with lower credit ratings, offering potentially higher returns, but also significantly higher credit risk and volatility. Important considerations. Not guaranteed stability. While the BOXX ETF strives for lower volatility, it's not guaranteed. Significant market disruptions or unforeseen events could still cause its price to fluctuate. Potential for lower returns. The dampening effect of the BOXX spread strategy on volatility might also translate to slightly lower returns compared to some similar ETFs, particularly those venturing into higher-risk asset classes. Actively managed fund. Unlike some similar passively managed ETFs, BOXX is actively managed, introducing an element of management risk. The fund manager's decisions regarding the BOXX spread and underlying securities can impact the ETF's volatility and returns. Overall, the BOXX ETF positions itself as a potential option for investors seeking a balance between low volatility and some degree of return. Compared to similar ETFs venturing into riskier asset classes, BOXX aims to deliver a smoother ride with potentially lower returns. However, it's crucial to remember that no investment is entirely risk-free, and the BOXX ETF is no exception. Diversification and a long-term investment approach remain essential for managing risk. Question 7. How would rising interest rates impact the holdings within the BOXX ETF? Rising interest rates can have a two-pronged effect on the holdings within the BOXX ETF. Direct impact on the underlying Treasury bills and indirect impact through the BOXX spread strategy. Here's a detailed breakdown. 1. Direct impact on Treasury bills. Treasury bill prices and yields. When interest rates rise, the prices of existing bonds, including those held by the BOXX ETF, short-term Treasury bills, tend to decline. This is because investors can now purchase newer bonds offering the higher prevailing interest rates. Limited impact due to short maturities. The impact of rising interest rates on the BOXX ETF's holdings is generally muted due to the ultra-short maturities, 1 to 3 months, of the underlying Treasury bills. Shorter maturity bonds are less sensitive to interest rate changes compared to longer-term bonds. As a bond nears its maturity date, its price becomes less volatile and less susceptible to interest rate fluctuations. 2. Indirect impact through the BOXX spread strategy. The BOXX spreads buffer. The BOXX spread strategy employed by BOXX ETF aims to generate returns similar to short-term treasuries irrespective of interest rate movements within a defined range. Potential for adjustments, however, significantly rising interest rates that push the price of the underlying security, often a treasury with a slightly longer maturity, outside the defined range could necessitate adjustments to the BOXX spread by the fund manager. Maintaining target returns. The goal would be to maintain the targeted return profile of the BOXX ETF by potentially widening the strike price range of the options or selecting new underlying securities. Overall impact. Generally milder effect. While rising interest rates can cause a slight decline in the price of the Treasury bills held by BOXX, the short maturities help mitigate this effect. BOXX spread as a potential mitigator. The BOXX spread strategy can further act as a buffer against some interest rate fluctuations, but significant rate hikes might require adjustments to maintain the target returns. Key points to remember. Not completely immune, the BOXX ETF is not entirely insulated from rising interest rates. Some price decline in the underlying treasuries is still possible. Focus on total return. The BOXX ETF aims to deliver a total return that combines potential capital appreciation from the BOXX spread strategy with the income generated by the held Treasury bills. Even if the price of the bills dips slightly due to rising rates, the ETF might still achieve its target return if the BOXX spread performs as planned. Importance of monitoring. Investors in the BOXX ETF should monitor how rising interest rates affect the ETF's holdings and overall performance. Consulting with a financial advisor can be helpful in navigating such scenarios. In conclusion, rising interest rates pose a challenge, but to a lesser extent, for the BOXX ETF due to its focus on short-term treasuries and the mitigating effect of the BOXX spread strategy. However, it's not a perfect shield, and close monitoring of the ETF's performance in such an environment is recommended. Question 8. What is the current sector allocation of the BOXX ETF? The BOXX ETF, unlike traditional sector ETFs, doesn't have a sector allocation in the typical sense. Here's why. Focus on underlying asset class. The BOXX ETF primarily invests in ultra-short-term Treasury bills issued by the U.S. government. These Treasury bills belong to the cash and equivalents asset class, considered the safest category within the fixed income universe. Limited sector exposure through options. The BOXX spread strategy involves options on underlying securities. These underlying securities might belong to various sectors, depending on the specific choices made by the fund manager. However, the BOXX ETF doesn't aim to gain exposure to any particular sector through these options. Focus on return and tax efficiency. The BOXX spread strategy is designed to capture returns similar to short-term treasuries with potentially better tax treatment. The specific sectors of the underlying securities used in the options play a lesser role in the overall objective. Transparency in holdings. Limited transparency on options. While the BOXX ETF discloses its holdings of Treasury bills, details regarding the specific options used in the BOXX spread strategy might be less transparent. This is because the fund manager might employ a dynamic approach, frequently adjusting the options based on market conditions. Focus on overall strategy. The focus for BOXX ETF investors should be on the overall strategy of achieving Treasury bill-like returns with potential tax benefits. The specific sectors of the underlying options are less relevant to this objective. Alternatives for sector allocation. If your investment strategy prioritizes exposure to specific sectors, the BOXX ETF might not be the ideal choice. Consider these alternatives. Sector ETFs. A wide variety of sector ETFs offer targeted exposure to specific industry segments, such as technology, healthcare, or financials. Broad market ETFs. ETFs like the SPDR SP500 ETF, SPY, offer diversification across various sectors represented in the SP500 index. In conclusion, the BOXX ETF doesn't have a traditional sector allocation as its primary focus lies in Treasury bills and the BOXX spread strategy for return and tax efficiency. If sector allocation is a priority, explore alternative investment options like sector or broad market ETFs. Question 9. Are there any concentration risks within the BOXX ETF? The BOXX ETF does have some potential concentration risks to consider. Here's a breakdown of the areas where such risks might arise. 1. Concentration in Treasury bills. Limited diversification. The BOXX ETF primarily invests in ultra-short-term Treasury bills issued by the U.S. government. While considered very safe, this concentration in a single issuer, U.S. government, exposes the ETF to potential risks if the U.S. government's creditworthiness weakens significantly. This scenario is highly unlikely but not impossible. 2. Concentration in authorized participants, APs. Limited entry point. The BOXX ETF relies on a limited number of financial institutions acting as authorized participants, APs. These APs are responsible for creating and redeeming ETF shares. Potential liquidity impact. If only a few APs are involved, and they face challenges meeting creation and redemption demands, it could affect the ETF's liquidity. This could make it difficult for investors to buy or sell shares at the desired price. 3. Concentration in option selection. Limited transparency. The BOXX ETF utilizes a BOXX spread strategy involving options on underlying securities. However, the specific details of these options might not be fully transparent. Manager dependence. The fund manager has significant discretion in selecting the underlying securities and options used in the BOXX spread strategy. If the manager makes poor choices, it could negatively impact the ETF's performance. Mitigating factors. U.S. Treasury credit quality. The U.S. Treasury is generally considered one of the safest issuers of debt globally. The risk of default on U.S. Treasury bills is extremely low. Regulatory oversight. The SEC regulates APs and ETF activities, helping to ensure some level of oversight and mitigate potential risks associated with limited participants. Managers' expertise. The success of the BOXX ETF relies on the skill of the fund manager in selecting appropriate options and underlying securities. Choosing a reputable fund manager with a strong track record can help mitigate some concentration risks. Investor takeaway. Weighing risks and rewards. The concentration risks of the BOXX ETF, while potentially significant, need to be weighed against its potential benefits of low volatility and tax-efficient returns similar to short-term treasuries. Diversification is key. Even if you choose to invest in the BOXX ETF, it's crucial to maintain a diversified portfolio to reduce overall investment risk. Consult a financial advisor. Discussing the BOXX ETF's concentration risks and your investment goals with a financial advisor can be highly beneficial in making an informed decision. Question 10. Are there other ETFs with similar investment objectives to the BOXX ETF? There are several ETFs with investment objectives similar to the BOXX ETF, although they might achieve them through slightly different approaches. Here are a few options to consider. ETFs with a focus on short-term treasuries. SPDR Bloomberg 1 to 3 month T-bill ETF, BIL, this ETF tracks an index of short-term Treasury bills with maturities of 1 to 3 months. It offers a straightforward way to invest in these low-volatility, low-risk securities, similar to the core holdings of the BOXX ETF. iShares Short Treasury Bond ETF, SHV. This ETF invests in a basket of short-term Treasury bonds with maturities ranging from 1 to 3 years. It offers slightly higher potential returns than BIL due to the inclusion of slightly longer maturities, but also exposes investors to a bit more interest rate risk. ETFs with managed strategies targeting low volatility. PIMCO Enhanced Short Maturity Strategy ETF, MENS. This actively managed ETF invests in a combination of short-term investment-grade bonds, certificates of deposit, CDs, and other instruments. It aims to deliver returns comparable to short-term treasuries with potentially lower volatility through active management. Simplify Interest Rate Hedge ETF, PFIX. This ETF utilizes a more complex options-based strategy designed to hedge against rising interest rates. While not an exact replica, it shares the BOXX ETF's objective of potentially mitigating the impact of interest rate fluctuations on returns. Important considerations. Expense ratios. Compare the expense ratios of these ETFs with the BOXX ETF. Lower expense ratios can improve your overall return. Underlying holdings. While all these ETFs share a similar objective of low volatility and potentially tax-efficient returns, their underlying holdings and specific strategies can differ. Research each option to understand its approach. Liquidity. Consider the trading volume and bid-ask spreads of these ETFs. The BOXX ETF, being a relatively new entrant, might have slightly lower liquidity compared to some of these established options. Question 11. How does the BOXX ETF compare to actively managed funds targeting the same sector? Here's a breakdown of how the BOXX ETF compares to actively managed funds targeting the same sector. Similarities. Investment objective. Both the BOXX ETF and actively managed funds targeting short-term treasuries aim to provide investors with low volatility. Investing in short-term treasuries offers relative safety and stability compared to other asset classes like stocks. Potential tax benefits. Depending on the specific fund and your tax bracket, holding these investments in a tax-advantaged account can offer tax benefits compared to taxable accounts. Potential source of income. Treasury bills and bonds generate regular interest payments. Differences. Investment strategy. BOXX ETF employs a combination of holding short-term Treasury bills and utilizing a box spread strategy on underlying securities, often treasuries with slightly longer maturities. This aims to achieve the target return profile with potentially lower volatility. Actively managed funds invest directly in a basket of short-term treasuries and other similar instruments. The fund manager actively researches and selects these investments, aiming to outperform a benchmark index or achieve a specific return target. Management. BOXX ETF, passively managed, meaning the holdings are chosen based on a predetermined strategy, box spread and treasury bills. Actively managed funds, actively managed by a fund manager who makes investment decisions based on research and market analysis. Transparency. BOXX ETF provides transparency regarding its holdings of treasury bills. However, details on the specific options used in the box spread strategy might be less transparent. Actively managed funds may disclose their top holdings, but might not reveal the entire portfolio composition due to proprietary strategies. Fees. BOXX ETF charges an expense ratio, which covers the costs of operating the ETF. Actively managed funds typically have higher expense ratios compared to ETFs due to the costs associated with active management. Choosing between the BOXX ETF and actively managed funds. Lower costs. the BOXX ETF generally has a lower expense ratio than actively managed funds. This can translate to potentially higher returns for you over the long term. Potential for outperformance. Actively managed funds, in theory, offer the potential for outperformance compared to a benchmark or the BOXX ETF strategy. However, achieving consistent outperformance is challenging, and many actively managed funds underperform their benchmarks. Management expertise. If you believe a skilled fund manager can outperform the BOXX ETF strategy, then an actively managed fund might be an option. However, past performance is not a guarantee of future results. Transparency and predictability. The BOXX ETF offers a more transparent and predictable approach with its focus on Treasury bills and the BOXX spread strategy. Actively managed funds can be less transparent and their performance more reliant on the manager's decisions. Alright everyone, that's all the time we have for the BOXX ETF today on Chat ETF. So, to recap, the BOXX ETF offers a unique approach to the short-term Treasury market, combining Treasury bills with a BOXX spread strategy. It aims for low volatility and potentially tax-efficient returns, similar to Treasuries, but with the possibility of even better results. There are, however, some concentration risks to consider, such as its reliance on the U.S. government's creditworthiness and the limited transparency of the options used in the BOXX spread. Ultimately, the BOXX ETF can be a compelling option for investors seeking stability and potentially higher yields than traditional treasuries. But remember, diversification is key. Consider how the BOXX ETF would fit within your overall portfolio strategy. And don't forget to like this video and subscribe to Chat ETF for more in-depth ETF explorations. We'll see you on the next one.